Canadian investors are using ZSP over any other ETF for exposure to the S&P 500 index. Institutional investors, investment advisors, and DIY investors have all been trusting ZSP with their investment dollars since the fall of 2012. ETFs provide instant access to a portfolio of stocks to an investor in a single, cost-efficient trade. For an investor to own the entire index would require institutional-level trading systems and expertise. To accomplish this, an investor would have to buy 500 stocks at a time, and then as the market moves, it would constantly have to rebalance those 500 stocks several times a year. ZSP simplifies this process by aiming to provide instant access to the 500 stocks in the index in a very easy and low-cost way.
Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 144. As always, joined by the three amigos, Boomer, Keith Dicker, IceCap Asset Management, Rich Diaz, over in Mexico. Is that where you are?
Yeah, Mexico City, the Ciudad del Mexico, I think is what it is. It's awesome. It's awesome. I highly recommend to anyone who loves a big, heaving, vibrant city. I haven't seen or heard from a vegetable in 6 days, but the tacos and the meat are fantastic.
Are you going to be able to make it through the whole episode?
I don't know. I mean, I had a bit of a stressful morning because the power went out on the entire city block because it rained last night and one of the trees fell. But I made it, boys. I made it. And honestly, just one thing on Mexico, if you love history and architecture and food and music, this place is for you. It's like a mix between like London and Tokyo. There's 20 million people here. It's the largest city at this altitude. It's 7,800 feet high. So it's tough for the first couple of days, but honestly, I could not recommend it enough. So if you love food and music and partying and art.
So to get this straight, so if London and Tokyo made it and had offspring, it would be
with an emerging market. It would with an emerging market. It's so big and yet it's vibrant. There's markets everywhere. The food's amazing. It's really a cosmopolitan city. It's just incredible. I'm blown away.
Just put that on the list. What
about you, Keith? How are you?
Yeah.
You look good.
Hey, I know. I'm taking care of myself. And I have a road trip next week going to Montreal. Tee us up, Steve. What's happening next week in Montreal?
The event that I will not be attending. I want to give everybody a reminder that Keith and Rich are hosting an event, a Montreal social hour. So if you're in the Montreal area and you want to hang out with Keith and Rich, have a couple drinks, some appetizers, July 18th, Thursday, July 18th, between 5 and 7 p.m., there's the Loonie Hour social gathering. So yeah, it's just going to be like our usual get together. It's just drinks, good times, chatting markets. There's a link in the description on Spotify, Apple, YouTube, wherever you're listening to this, there's going to be a link where you can go to Eventbrite, purchase a ticket. It's $20. The $20 covers drink and appetizers. So like, again, this is not a moneymaker. It's simply just a way for us to connect with our audience and get to know everybody on a more personal note. So again, Montreal Thursday coming up next week. Is it next week? July 18th. I don't know. I've lost
We record
track.
this on a Thursday.
So actually next Thursday. That's what it's going to be.
If you're listening to this episode, there is still hope for you because it is in fact next week, July 18th. So there you go. Keith, but with that said, we also have a special guest today. So I don't know if you wanted to tee up your good friend, Michael Nicoletos. I hope I said that correctly. But I'll let you have at her.
Okay, that is pretty good. So we have a guest today. He's a very dear friend of mine. His name is Michael Nicoletos. He's based out of Athens most of the time, but he's traveling around Europe. He's over to New York quite a bit and stuff like that. But Michael's background is quite interesting. He's the founder and CEO of a firm that he set up. It's called DeFi Advisors. And so they specialize in digital advisory, crypto, macroeconomic, things like that. He's also on the investment committee for two pretty big family offices over there in Europe. And he's also an advisor to another pretty large corporation where he also contributes to M&A strategies for them. He's deeply involved in the Greek Angels network, so business, seed capital, things like that, Hellenic Business Angels Network. And prior to that, Michael, he co-founded an emerging market equity long short fund that was based out of London for over 10 years. So he's a really smart guy, and we're going to have a great conversation with him right now. And I think everyone's going to get to see how it ties in to how things might be moving in Canada coming up pretty soon. So here we go. We'll have Michael Nicoletos here coming on right now.
Let's bring him in. Michael, welcome to the Loonie Hour.
Nice to be here. I'm a big fan, and being in Greece, I tend to listen to you guys, and it's really fascinating. And I love the show and the way you have the discussions. It's quite unique.
An audience in Greece. There you go. That's the next Loonie Hour meetup.
You're invited. You should have one here. You're more than welcome.
You might be our only fan over there, but it will be a good time nonetheless.
I'm sure there are more Greek.
So Michael, you and I met a few years back through Brent Johnson. So Brent introduced us, and we have this continuous 24-hour DM or private chat room going. But when Brent first introduced me to you, Brent said to me, he said, "Hey, I want you to meet this guy." And I said, "Why?" And Brent said, "Because he's the sharpest mother fire trucker you're ever going to meet." And I said, "Okay, great." Because one thing I want to do with my network, I want to surround myself with some really smart guys who are very approachable, can give me different things to think about. And you do that all the time. I love it. But for everyone to understand as well, you're a really nice guy. You're one of the nicest humans on the planet. And I only want to be your friend because you are that way as well. So it is important. Yeah, it is important though. It's important though in everything that we do in our lives. We want to learn stuff from each other, but you want to like the person you're dealing with. And I have a lot of love for Michael. So I thought today what would be great for everyone following us was to listen to Michael's views on China. Specifically, we've been talking about factors or different events that could be triggered or escalate into something that's happening outside of Canada that could come back to affect us here in Canada. And that's such a great thing about what we do in a podcast. And we have great conversations about things from all over the world, but we like relating it back to Canada. And these days, Europe gets a lot of attention, geopolitics are getting attention. We mentioned Japan quite a bit recently here on the podcast and the Canadian market, but China should really be capturing everyone's attention for a number of reasons. And that's the conversation that we want to have today. So why don't we just dive into it? Give us your thoughts on what you're hearing and reading and dreaming about when you're on the beach over there in Greece these days.
In Greece, we only work on the beach. Now, thank you for your kind words, Keith. The feeling is mutual. And I'm very glad that Brent introduced us. And we have this 24-hour, 7 days a week discussions on any subject. Usually not important stuff, but that doesn't matter. So it's really great. And thank you all of you guys for having me. Now, China. How did this come up? Well, I've been looking at China for many years, and I've been thinking that something wasn't going well for a few years now. So from a market perspective, I've been wrong because I think I've been too early, but these things take more time to evolve and develop, and usually they need external factors to come up to the surface. So China is in a very fragile state. And the reason that I think now is an important time is because I think of it this way. I think the US understands the fragility of the Chinese economy right now, and it's pushing and pressuring China in two ways: A, by discussing tariffs; B, by helping the dollar appreciate. Now, these two things going together are squeezing China right now, and problems are popping up, which most people can see in the sense anyone who's following China will see that last week 40 banks vanished. So what do I mean vanished? They were absorbed by larger banks. Now that doesn't happen in an economy which is booming. So what's wrong with China? Now, what's wrong in China is that China is highly leveraged internally. And when I say highly leveraged internally, I mean that its banking system is around $57 trillion in terms of size. That's a huge number when you calculate that the GDP is around 17 trillion. This is like 330% of its GDP. In the US, it's 1-to-1. So the US banking system is 100% to GDP. So just to put the numbers into perspective, because we throw numbers and unless it's a relative discussion, no one can understand what we're saying. And in terms of global GDP, it's 54% of global GDP now. If the banking system of China's banking system is 54% of global GDP, I think this is a pretty big issue. The US, I think, was 32% in 1985, and Japan was at 27% in 1994. So these are the relative peaks that these economies reached. Their banking system reached these peaks during these periods. So China has gone through that, and it's now in a much higher level. If you think that 1/3 of it is lending to the property sector, and we've seen what the property sector has been doing the last 5 years, we can understand that the losses are huge there. Just if you look at the IMF reports on China, you'll see that Chinese banks have only taken provisions less than 2%. Less than 2% in a real estate sector which has collapsed. 1/3 of the banking system has invested in the property sector via lending, and that's a huge problem. Now, if you add the losses on the stock market, which since 2021 exceed $5-6 trillion, now we're talking about $10-15 trillion of losses. $15 trillion of losses in a 57 trillion banking system is a huge number. The GDP, China's GDP is 17 trillion. Make it 18 if you want to make it, if you want to round it up. So that fragility at a time where China needs dollars more than ever is very important, and I think that's what has brought China into the up to the surface, and everyone's looking at it right now. That's how it feels to me, at least. I don't know, because I've been following China for some time, so I'm a bit biased in that sense. So maybe I'm seeing green shoots everywhere in the sense that I've been looking for it. I don't know how you guys are looking at it, which would be helpful for this discussion for me to understand how someone who has not been following it for so long understands China.
So what I'm hearing then is something, one part of the conversation I love, you mentioned, what the banks are doing for provisioning for bad loans. And that's something that we follow quite a bit here in Canada. And so from the Canadian perspective right now, the commercial banks here, every quarter, they're now provisioning more and more for bad loans on their books. And that's good because it is trending in that direction. They need to do that from an accounting perspective. But the amount of provisioning on an absolute basis, it's still no higher than the highest levels they've reached over the last decade, and that's with no recession. And then as a percentage of their loan books, it is still, quite small as well. But when we relate this to the Chinese story, what I'm hearing from you so far, Michael, is that, that the banks have simply lent out too much money in their economy. And that's something that we've talked about and joked about here for quite some time, that, there was never no Asian miracle. It's just a leveraging miracle. And Rich always likes to say, hey, come on, it was a bit of a miracle in there somewhere, Rich. I think you would prefer to say every now and then.
I would, but carry on.
Yeah. So, but now though, after borrowing so much, and we know the economy, it is quite centralized over there. You know, they are directed, they need to lend out so much. What has to happen for this hard landing not to occur in the banking system? Is it simply they have to lend better, or they need the global economy to pick up, or they need to sell more stuff? Like what is causing it now to become a bit of a bad loan problem?
Let me give you a few insights in that sense. Now, for those who don't know, China has capital controls. You cannot take more than $50,000 out of China. And if you do, you're either doing it through invoicing or you found ways to do it. But for the average person, it's very hard to take their money out. So given that they have capital controls, which means that the money inside the system does not leave. And what do I want to say? Why do I say that? How does China finance? How does it finance the economy? It had been driven by investment, and investment was the primary engine of growth in China. So that primary engine of growth went mostly to the property sector. And as the property sector went lower and lower, they continued to pump more money. Now, if you look at the deficit, because we talk about the US deficit, the US fiscal deficit, we don't look at the Chinese fiscal deficit. The official number is 3%. Now, the unofficial number is around 7. I would say it could be up to 15 according to the IMF. Now, the reason that we don't see that number, and the reason that people think it's only 3%, is because they fail to include half their budget. They don't include the state capital operation budget. They don't include the social and insurance budget. They don't include the supplementary funds from past reserves. They don't include the special government bonds managed under the government. So if you include all that, suddenly the deficit is not 3%. It's between 7 and 15 if you want to take the IMF's estimates for various years. So we talk about the US having a fiscal deficit of 7%, but we're not talking about China having a fiscal deficit of 7%. Now, they've been doing that fiscal deficit, but who's been buying those bonds? The state bank. And how has this been financed? By increasing M2. M2 is the money circulating in an economy. It's actually the money you can spend, if you want to say it in a simplistic way. And M2 right now in China is $41 trillion. $41 trillion in an economy which is $17 trillion. The US has an economy of $27 trillion and an M2 of $20 trillion. So it's like putting air in a balloon. The air can't go out, and the balloon grows. Now the question is, how does that balloon pop? What makes it pop? Or what's the threshold where it pops? Obviously, these are hard questions. But in order for that not to pop, and why am I saying that? Because the FX reserve, China's FX reserves are 3 trillion. And then when everyone looks at China's FX reserves and they see 3.2 trillion, they say, 3.2 trillion is enough. The external debt is less than that. So there's no need to be afraid of that because China does not have a big amount of external debt. Yeah, but I'm looking at the other way. What's the amount of money that could potentially leave? Let's assume tomorrow morning that capital controls were taken off. You think that the Chinese would keep their money into China? In a banking system?
No way.
Which is
they're going to go to They're going to go to Vancouver.
It's Solano.
To buy some housing.
Okay, they're going to go to Vancouver. Most likely they're going to go to Vancouver and they're going to go everywhere in the world, but not China. So the question is, do you think in a 57 trillion banking system, $5 trillion, $10 trillion are not an amount which would want to leave the country? I think it would, given the circumstances and what we're talking. And now we're talking about 20% of the banking system. We're not talking about something, tremendous like 50, 60%. So the question here is, how does this continue without breaking? Now, how has China done it until now? China did it through two ways, through FDI and through the current account. Now, the FDI numbers, which are the number of money and investments that come into the country, have gone from 10% of GDP to 1.5% of GDP. Last year, they were 82% lower than 1993, the FDI. So FDI is collapsing. No one wants to invest in China. And I'll come back why no one wants to invest in China, but no one wants to invest in China. People are taking their money out if they can, and if they can't, they're not putting any more. And now when we talk about these numbers, we have to include that most of the money that comes into China is through round tripping. 25% of the money goes to Hong Kong and comes back. So take that money. And if you include that most of the numbers that the PRC is disclosing are not verified, maybe the number is even worse. So the numbers, the public numbers, I will assume that they are the best case scenario. Because if they were better, China would have an incentive to make them even better. So if this is the best case scenario, what is the worst case scenario? Money leaving in China. Second, current account. Through the current account, which is how they've been growing, the amount has gone down. People, the trading and through the tariffs and through the whole, I'd say, trade wars has collapsed the export engine of China. Now, China has been focusing now on EV cars and everything, which is one sector of the economy. But going from an investment-driven economy, which is 43% in the case of China, to a manufacturing economy, which is already 27% of GDP. In the world average is 14, and I think in the US it's 10%. How higher can you take that number? And who's going to buy your cars? And who's going to buy your cars when the European economy is in a recession and European politics are in a bit of a mess, I would say. So how do you bring more dollars? You don't bring more dollars. And that's what has been causing everything to start, circulating and people seeing that things in China are not doing that well. That's why the stock market has fallen. This is why the real estate cannot be propped up. The Chinese government does. On the one side, it wants to deleverage the local governments. And on the other side, it wants to keep the prices up. You can't have both. The local governments have off-balance sheet debts of $9 trillion, 50% of GDP, and $9 trillion are off-balance sheet debt of the local government.
Michael, what's off balance sheets? Just so people understand. Sorry.
So the local governments have created these vehicles where they can lend to the economy, which are not on balance sheet, so they do not disclose them. So they have debt, which is not registered on the official debt numbers.
So like guarantees, they guarantee people's investments and stuff like that?
They guarantee, they have other schemes through the wealth initiatives. They have some, I don't remember the name now, it's the wealth funds. They have some wealth funds, which they use a lot. So through these vehicles, they've been lending in the economy and they've been not disclosing the debt. The government knows about this debt, so they try to deleverage the local government. But how can you do that and keep prices up? How can you deleverage local government and keep your GDP at 5%? How can you keep your GDP at 5%? If you stop lending, and we're talking now about economy, which is using, depending on what GDP number you use, but let's take the official numbers of GDP, they're using 13 units of credit to create 1 unit of GDP. You need 13 units of credit to create 1 unit of GDP. Every year, this number goes higher and higher. So you need more and more debt to keep the same rate of growth in the GDP number. This is absurd. It's absurd. It can't be sustained. So that's the main problem. Now,
so Michael, you just insulted the Canadian government then, by the way, by saying that.
I apologize.
We have the same challenge here as well. It takes more and more debt, more and more population growth to produce the exact same amount of GDP. So the world is kind of synchronized here in
Sounds like a Ponzi.
I don't know if we can use that word. Can we do that?
If you create money, it's not a Ponzi. A Ponzi is you use other people's money to create more value for your money. If the government is giving money to everyone.
So can I just ask a quick quick question just to relate it to Canada. So, I mean, there's been a huge investment into real estate, and we've said many times that real estate is not necessarily the most productive asset. Similar situation that happened in Canada, where a huge amount of money flew into real estate investment. There was a speculative bubble, and less money was allocated to sort of more productive assets. Sorry, Steve. And now we're seeing sort of the tide go out, which is similar to what's happening in Canada. Do you think we're at sort of the beginning? Are we in the first innings of this? You know, when you look at the official numbers for year-on-year house price growth, they're a laughable -3%, -4%, -5%. So, I mean, how far along in this process of the not delevering, but in the house price decline? Because we know in some economies, eventually you do find a bottom in those house price decline. In Greece, Ireland, Spain, you eventually found a bottom. So how far along are we?
First of all, in Greece, we blew up. You haven't blown up yet. So until you blow up, this is not a relevant discussion. But you need to follow the flow of money. Okay. So if the flow of money is coming from China to Canada's real estate sector, I know that the Chinese have been buying real estate massively in Canada. I don't know the numbers exactly. So I from headlines and from what I read, I've seen that there have been huge investments. What I can say, looking at from the China side, not from the Canadian side, is that if you look at net FDI, meaning money coming in and money that China invests abroad, okay, or the Chinese people invest abroad, net FDI has gone negative, which means there is a net divestment from abroad. So maybe at this stage, the new investment has paused in Canada, so no more money is coming in. But looking at what's happening in the world, I think that slowly money will be leaving Canada in the sense that Chinese will need to sell some of their assets, or they will be forced by the government to sell some of their assets and bring their money back. So I think we should see that in the next 18 months.
Can I just
manifest?
Yeah, I just wanted to chime in quickly just to give people a little bit of context. Just again, I think Vancouver is kind of like the mecca for Chinese investment, at least in Canada, anyways. And so I just remember like so vividly being in the industry in 2015, 2016. That was like the peak foreign capital flows coming into Canada, into Vancouver. And house prices just ran up so rapidly. I remember like having, you have a listing, you have a bunch of people coming through, you'd get these Chinese groups coming through, you'd be chatting with their realtor, and they would be like, well, yeah, my client's just here, they're flying in for the weekend to buy some real estate, and then they're leaving. So like, we got to put an offer in this weekend and then we're out of here. Like, and a lot of the times these offers would be sight unseen. And I remember like the local population, right? Because everything was like in competing, like multiple offer bidding war situation. And as a buyer's representative, the first question you would ask the listing rep is you'd say, well, okay, I'm competing with whatever 10 people. The first question you'd ask is, am I competing with any Chinese? That was the question everybody asked, because they're like, I cannot compete with the Chinese. At that time, it was just like there was no number too great. It was literally just like you could tell it was just a mechanism that they wanted to get money out and park it here. And I can tell you, obviously, since then that has completely died off. I really actually peaked in about 2016, 17. And since then, it's kind of been a trickle. And my sort of proxy for that is if you look at the high-end luxury real estate market, it's been stagnant. It hasn't got, Michael, it's gone nowhere. It's gone nowhere since 2016. Prices
but it's flat.
They're flat. They're actually slightly down. In the high-end luxury market where a lot of that capital flowed into, the prices have not moved in 8 years.
Wow, that's impressive. But again, you haven't seen them falling.
No. I mean, not. They fell a bit. They definitely fell a bit. They kind of recovered a little bit, and they've basically just been tracking more or less sideways. And so, if you look at it, there's been no growth for for the last 8 years.
Yeah, well, this is one issue. Now imagine the Chinese wanting to take their money out. Now, how do the Chinese protect themselves? They have a few ways. One is buying gold. And why are they buying gold? And that's why you see a premium price of gold in China, because China, they're still allowed to buy gold. So if you have your money in a banking system, which you believe is not really safe, you cannot take your money out of the country. What do? You buy gold and you buy Bitcoin. Again, you cannot buy a lot of Bitcoin because they've made it very hard for the Chinese, but gold is still something they can buy. So they don't care to pay a premium. Then having a safety net, like an insurance, the premium is an insurance price, then having their money in the system. Now, those who can have a subsidiary company or another company in Hong Kong, and they over invoice their other company, and they take their money out. Now, another total data point is if you go on the PBOC and you look at import exports from Hong Kong, and you go on the HKMA and you see exports and imports from China to Hong Kong, you would assume that these two numbers would be the same as the other two numbers, or at least it would be close. Imports of one would be the exports of the other, the exports of one would be the imports of the other. The difference between the two is by a billion magnitude different. The two numbers do not reconcile, they're not even close. Last time I checked, it was like a huge number, huge number. I haven't checked in the last year, but the number is absurdly big.
Can I ask
something?
Sorry, can I just ask a question? Just maybe I'm getting ahead of myself, and forgive me if I am. So, I mean, is the end game? You mentioned currencies, and you mentioned crypto and gold and stuff. So, isn't the end game that they move away from the peg? I mean, that's what you're saying. I mean, if you have nature abhors a vacuum, and one way to sort of fill that is to have a much lower sort of won to US dollar, right? It's pegged around 7 or whatever it is. I mean, isn't that ultimately where we're going? Or do you think that they will defend that for a multitude of political and ideological or reasons?
Let me start it the other way around. I don't think they can avoid it. They can try and make it gradual, and they will do their best to do it gradual. So, if a currency falls 0.5% a month, it's different than if it falls 3% a month. It goes a bit under the radar, if you want to. It doesn't become a headline. So I think they're trying, and that's why I think if you look at the CNH, it's gone to 730, 728. It's been gradually falling. Now, I always do this exercise, and I play around and trying to say, if you were the Chinese government, what would you do? What would you do? I'm trying to figure out ways. You have a banking system which needs to be recapitalized. One problem, which it would need like 10 trillion. I don't know how much it is, but let's put 10 trillion as a number. Where do I find $10 trillion? One question. Actually, I'll tell you where you find $10 trillion. Second is, I need to make my economy grow again. So I need to lower my currency because tariffs are coming. So I need to find a way to make this even. So lowering the currency is one issue. And thirdly, I need to maintain social solidarity and no unrest and no inflation. Okay, not very easy to do all three. My feeling is, and I don't have any data on that, so I'm telling this out of my head. I think China will use the excess savings of the Chinese people to recapitalize their banks, so it will do a bail-in. So suddenly, if you have money in your bank, a portion of that will be used to recapitalize the bank. That's what happened in Cyprus, for example. Once that happens, banks will be recapitalized. Then they will allow the currency to fall a lot. And then after they do that, in order to build trust on their currency, they're going to peg it to gold or something like that. They're going to say, look, I'm a hard currency. I don't fall anymore. You can all feel comfortable that we're fine. That's my feeling. Okay, maybe I'm wrong, but that's how I think it could play out. Or else I don't know how they can recapitalize their banks. And I don't know how they can do it without creating inflation. And inflation would create social unrest. So I think that's a bit of a tricky situation. But that's the way I see it, at least.
You think, Michael, instead of, I mean, we all understand that process. You have to capitalize the banks, and you go through there. And like one thing you mentioned earlier, the big, I don't know if everyone caught on to it though, but it's incredibly important to understand China because they have a closed capital account. It means as you mentioned, you can't get your money out. It's like 50 grand you can try to squeeze out every now and then. So if they did relax their capital account, they open it like what the Americans have and Europeans and Canadians and so forth. As you mentioned, immediately capital is likely going to leave. So that eliminates their so-called 3 trillion in excess reserves. So therefore you come back to the whole currency side. They have to control that so it doesn't go out of control. So instead of China looking at themselves internally for a solution, is there an external solution for the Chinese that could somehow make things better? I don't know what it is, besides the world growing rapidly again with no inflation, no debt, and all those, no tariffs, globalization adopted, things like that. But is there something that could happen externally? And then another thing to add on to that, are they looking more closely at another economy like the Japanese, for example, or someone else that they should be equally as worried about instead of the Americans? That's a lot in there, isn't it?
Yeah, quite a few.
Remember, you're the smartest guy I know, so I know you can answer all of that.
Right. I know now why you did that. You put me in the corner, but thank you, Keith, for that. Thank you. It's very helpful. Now, okay, what could be first of all, an external situation could be a Shanghai Accord, like it happened in 2016, where G20 get together and they agreed to lower the value of the dollar altogether because it was squeezing the world. So that could be something. So I guess we should be looking for something like that. But I'm sure that the US will not give up its ultimate weapon without getting something in return. I'm not sure what they're looking to get in return, but I'm pretty sure that they're having discussions. Yellen went twice in the past quarter in China. Quite a few US representatives have gone to China. So I'm pretty sure there is a discussion happening behind closed doors. I'm not sure they have found a solution, because if they had, things would be smoother. But I think that's the pressure point US is putting on the table. So yes, there could be something externally that could help, or lower tariffs, or reduce tariffs, or there are quite a few things that could help China right now get out of this mess, or postpone that situation where it has time to resolve it in a timely manner instead of an abrupt manner. So I think that could be the case. Now, regarding Japan, the big problem with China and Japan is that Japan, the currency, I'm pretty sure that everyone has noted right now that the Japanese currency is falling. It's gone to 158 versus the dollar. It's a headline discussion in every meeting. Why is the yen falling? Will the yen reverse? For whatever reason that the yen is falling, let's not go into that discussion. The fact that the yen is falling means that it becomes more competitive toward the Chinese currency. So me as a foreigner, I can buy something from Japan, which is better quality than the Chinese, and now at a cheaper price. and now at a cheaper price. So what am I going to buy, the Japanese or the Chinese product? I'm going to buy the Japanese. So as the currency falls, this puts extra pressure on China, because now it doesn't only have issues in selling its products abroad, it has competition in selling its products abroad. So this is a nightmare for China, the fact that the yen is falling. So this is something that one should be looking at for. I think my view has been that if there is a Shanghai Accord, and I'm saying a Shanghai Accord because it was never officially announced, so no one ever got a headline that this happened. It's through what is written, through what is said. It's like everyone knows about it, but it was never officially confirmed. How would you be able to know that the Shanghai Accord has happened behind closed doors from a market perspective? What would be the indicator? My personal view would be that you would see the yen rallying. So if you see the yen rallying one day, or you see suddenly a U-turn yen, I think in some room, in some discussion, something has changed. And I think that would be a good leading indicator to watch if you want things to see if they're going to U-turn from where we are today. Until today, we haven't seen anything. The yen is falling. Every time it goes to 160, the Bank of Japan intervenes. It keeps it at 158. It doesn't want to make a huge mess. So they're doing a gradual devaluation as well, if you want to put it this way.
Michael, is the Shanghai Accord the same as the 1994 Plaza Accord, where Volcker
the Shanghai Accord was unofficial.
Right. That's what I mean. So one was unofficial, but
in essence, they had the same goal, and they never did. They never said that they did it. So yes, if you want to say it that way, but if you remember, 2016, China again was in a dire situation. And the way it was resolved, it was that. And in 2016, China was not in the mess that it is today. The mess that it is today is twice worse, or maybe 3 times worse than it was in 2016. Because if you accumulate the credits needed to create a unit of GDP, and you count all these years, now you get the number. You need 13 units of credit to create 1 unit of GDP. It's crazy. It's crazy.
Can I ask one more question?
It might be wacko, right, Rich? Up here,
it's very wacko.
Being wacko.
Let me ask one more question. To what degree does China's population decline, and certainly its working age population decline, play a part in all of this? And there's 2 parts to that question. One is the economic impact, but also the political impact of it.
Well, I obviously plays a role, but this is a slow-moving train. It's not something that will trigger something tomorrow morning. We know it's coming. It's happening in a gradual way. Okay, every year will be tougher to produce the same amount of GDP, but it will be in a manageable way. So yes, demographics are a very important component of growth, and usually the problem comes in pensions, where they have to pay the pensions, and then there are less people to produce the same amount of growth and numbers to pay for their retirees. So that's the problem. But that's not something that will happen tomorrow morning. And again, they had the one-child policy for so many years, and that's why they have this issue now. Now they've abolished the one-child policy, so they will try their best to try and create, population growth again. And easier said than done. It's an issue, and it's a big problem, and this is a big problem, I would say, across the globe, not only in China. But the more indebted you are, the bigger the weight of the population decline has on your economy. If you have zero debt, let's assume a fictional situation where you have zero debt, yes, it is a problem, but you have the money to pay for what's happening in the economy and for the pensions. If you have reached the max limit of your debt, what do? You need to monetize your debt somehow, or to find ways to bring money into the economy.
Let's go with one more question here. You've been very generous with your time, and
for you, Keith, anything
for you, man. And it's not it's a bit of another one of these. I don't think it's a deep thinking question, but it's something to go through. Let's just say we do have the event where there's no kind of an agreement reached between China and other parts of the world and nations, and for whatever reason, that they do have their debt system does collapse. They make that internal decision. Hey, we can't hold it together anymore. So kind of like what happened with the Americans, their housing crisis when that blew up, and then, the resulting effects from that. Why not just give us a quick view what could potentially happen to the rest of the world if the Chinese debt problem or bubble or challenge, it does make a pretty severe event move very, very quickly.
It will be the biggest deflationary tsunami that we've ever faced. If you think that COVID, the central banks came in and printed money as much as they could to avert a collapse, if a Chinese bubble bursts, they'll do the same on steroids. So I assume that if we had an event that would trigger such a deflationary tsunami, central banks across the globe will come in, as they did during the COVID time, and give as much liquidity as possible. through any venue they have, and maybe create new venues, because central banks have been very creative, I have to say. Every time they find a new way to give liquidity and change the name, and you have to understand the new name, what it means. So I have to say they are very creative in that sense. So
Well, but that's the Europeans. I mean, the Europeans come up with about 38 different acronyms and names for every...
the US is doing very well now. What was the last name they did to absorb US treasuries from the bank's balance sheets, and so that the banks would not need to take their mark-to-market losses? They had the name for it, but again,
Yeah,
it was
absolutely.
a creative one.
So what you're sharing then with the for everyone to think about is, it's again, central banks will rush in and they're getting much better at it, because they had a lot of practice to do it all at the same time there a few years ago. But that is that's a conversation that we've had consistently here on the podcast as well. And so it is something to think about, because central banks have to bail out their local bond market all the time. They have no choice, because otherwise it is going to create some unpleasant, markdowns and stuff like that for the bank level. But it is interesting to watch. Do you guys have any other questions?
Yeah, well, Michael, is that part of your thesis for DeFi crypto? I know you're active in that space. But as a guy that, seemingly was more traditional macro, it's interesting to see you get into that space.
Well, I got into that space because I found it fascinating. I saw so many people go in. I said, there must be something here. So a lot of good minds have gone into the space. Like any space, there is fraud and there's good stuff. So usually most that are not in the sector will look only at the frauds and say, another bubble or something. So I think there's a lot of technology in there. There are a lot of new ideas that will solve a lot of issues going forward. I think the blockchain, which everyone knows by now, is a good way to have, let's say, how do you call it? The database of all the transactions, everything that goes from money to data to information. So it's a logbook.
CBDC.
CBDC, yeah, okay. CBDC
Just say no,
well.
kids. Just say no.
CBDC as well. Now, I think if you step a bit back, what has been driving markets? Markets have been driven by liquidity, nothing else. Because if you go on a macro to macro comparison and to where the stock market should be, it doesn't make sense. It doesn't make sense. You cannot have that amount of growth, that amount of debt, that amount of profits, and have the stock market where it is today. So why is the stock market up there, and why has nothing broken yet? Because there's huge amount of liquidity, and that amount of liquidity goes also into the DeFi sector. And the DeFi sector, which is like investing in a VC, so you're investing in 10 projects, and one of them will go 50x if you're lucky, or 100x if you're lucky, and you'll make all your money. That's the same thing like DeFi project, but they are so innovative and so groundbreaking that some of them are really, really fascinating. So I think as long as we see great minds going into the sector, we're going to see also great product which will come up soon. And I think this is a sector for someone who looks at technology that they should pay attention. And it's good to spend time on it and read about it, because not everything is the same. Because I'll give you the most common example. When you talk to someone who hasn't spent time, he will ask you, what do you think about cryptos? You will give them an answer, and then they will say, what do you like, Bitcoin, Ethereum, or Solana? I'm giving you an easy question. They don't understand that Bitcoin and the rest are not the same thing. And I understand why they don't understand the same thing, because they haven't spent any time. But until people start spending time, there will be that bucket, it's a gray bucket. All the things are the same. There's a lot of fraud, yada, yada, yada. So I think all that liquidity that is in the market now, and probably will come in as we see deflation come back again. I don't think we see inflation anymore, unless we see wars and we see commodity prices going through the roof, which I cannot predict. Clearly, we could have wars. Or else equal, I don't see we see inflation anymore. We're going to get a deflationary shock, not an inflationary shock. Markets are positioned for inflation when I think they should be positioning for deflation.
Which is, I wouldn't mind pulling on that thread just ever so slightly, because that's sort of, maybe slightly counter to what we've been discussing on the Loonie Hour over the last, 3, 6, 12 months. But, I don't necessarily disagree with you, to be honest. I mean, I think there's a lot of, risks out there. And I think I mean, Rich, Keith, I don't know if you have any thoughts or pushback on that. But I mean, I guess, Michael, my question was on the China side. Do you see more deflation outlook? So, I mean, obviously it's important for Canadians that are looking to renew mortgages over the next 12 and 24 months. Do you see that deflationary impulse coming through? I mean, there's also been the counter argument. You hear this popular thesis online. And again, I'm curious for you to debunk it. But, okay, well, China needs US dollars. And one way to get the US dollars is to sell US treasuries. And is there going to be a bid for US treasuries? So yields are going to spike higher. And so you hear that argument on Twitter quite a bit. And so I am kind of curious how you weigh the China deflationary bust aspect with the China disinvesting from, say, US treasuries.
First of all, let me answer the second one. China is not divesting from US treasuries. China has been selling US treasuries through its PBOC account, and it's been buying treasuries through its Luxembourg and Belgium account. So effectively, it's the same number. They haven't changed their US treasuries hold. If they have, it's a small number. That's what I'm saying. So officially, everyone's looking at the PBOC. They think they're selling, so they're selling. So they've been doing it in a smart way, and people think that this is the case. So to clarify that, they're not selling. One thing. Second thing, deflation in China has already started. Stock market is down. Real estate is down. The GDP print for 2023 was 5.2%. Okay. I want to ask a question. If 43% of GDP is investments and 43% was zero, how the hell was the rest created a 5.2% growth number? Seriously, how that? No, it wasn't. So deflation has already
I think
started.
it means it grew at 10% or more.
Yeah, exactly. So what grew 10% or more? What? There's nothing that grew more 10% or more.
Can I push back on the inflation? Oh, sorry. I just want to push back on the inflation thing. So, I mean, we know that it's not just China that has loads of debt. Canada's debt to GDP is 300 whatever percent if you include public and private. We know a bunch of other countries are in a similar situation. One way to deal with that is to raise taxes or to do austerity. Austerity is just not at all politically palatable. It's just not going to happen. I don't, even if the most right-wing populist gets elected, I don't think they're going to start running budget surpluses. So another way to do it is to raise taxes. We'll see. One way that you can raise taxes by stealth, as many an economist has suggested, is through inflation. And you've talked about and liquidity injections, so you have allowing inflation to run hotter for longer is effectively a tax. That's one way to deal with these debts. And you mentioned liquidity injections if anything goes bad, which ultimately, in my view, are inflationary. So, I mean, isn't that sort of a counter to your deflationary argument? Maybe not in the near term, but maybe in the medium term?
Let's assume you have a bucket full of water. And let's assume that this bucket has holes so the water is leaving, okay? So if you have, let's say, a real estate market that's collapsing or deflationary pressures, is the money leaving the bucket. Okay. In order to get inflation is to put more water in the bucket than the water that's coming out. So, flood the bucket. What happened during COVID? Central banks got so scared, they flooded the bucket. So we suddenly saw inflation, but the holes never closed. So the money is still leaving through the holes. And this is what's happening in the economy. The real estate in China is not doing well. Obviously, in Canada, real estate is not doing well. Or maybe it's not booming or it's not falling, but it's definitely not doing well. Okay? In Europe, the European economy is in a mess. The UK economy is in a mess. The only economy doing well is India. Okay. India is doing well. But you need the whole world to do well. So my question to what you're saying is, let's assume you're right, and they increase taxes or if they increase taxes, the economy will go even a bigger recession, and that will be even more deflationary. But if they do it through inflation, how do they do it through inflation? They need to cause prices to go up. So they need to create demand. Inflation can go up through two ways, either by increased demand or by lowering supply. That's how the inflation happened in the beginning. You had a huge, China was not sending products, so prices went up. So you had a supply shock. Now, what did the central banks do? They addressed the supply problem of inflation with demand tools. That's why it didn't work. Because in order to stop inflation from the supply side, you need to use supply tools, not demand tools, because you cannot affect, if oil and grain are through the roof, what are you going to do? You're not going to eat, or you're not going to put your car, turn on your car. You know, there are some products which are inelastic, so you're going to spend whatever the case is. Now, if it's demand driven, which means the economy is doing well, wages are going up, things are doing well, that's a good problem to have. I don't think any central bank cares about having inflation of 3.4%. We've gone through phases where the inflation was 20% and everyone was fine. Central banks are more scared than deflation than inflation. Inflation, they know what to do. They don't care. They deflate their debt, as you said. I agree. Central banks do not want deflation. I'm not saying they want deflation. I'm saying deflation will be created because the water running out of the bucket will be, the holes are going to get bigger and bigger. So suddenly the central bank will wake up and going to flood the bucket again. In central banks,
so you agree. So you agree with my statement, which is you have a short-term deflationary impulse, which you can't avoid, which is because real estate's bad, productivity is poor, but ultimately it will lead to government's massive structural deficits that are sustained and central bankers that pump in liquidity. So I mean,
wait. One thing. It's deficit creates inflation.
Right.
This is budget-wise. This is fiscal policy.
Right.
Fiscal policy creates inflation. Monetary policy has been proven that it doesn't create inflation.
Mm-hmm.
It hasn't.
Asset inflation, maybe.
Asset inflation. I agree. I agree on the asset inflation, but your daily life did not get so expensive. Yes, you could not afford to buy a house. You had to rent. If you had 3 assets, you gained in value. But your everyday inflation problems were not that big.
Fair enough.
The fiscal deficit is what created the inflation. Now, if you want to cut inflation in 30 seconds, take 7% deficit to 3%.
You're going to get banned from Canadian YouTube, I can tell you right now.
Now, if the easiest way to take inflation from 7% to 3%, or 3% to 1%, whatever the number is, take your deficit to half, cut your deficit to half, and you'll see deflation. You will never talk about inflation again. I can guarantee you.
And I just want to make sure all the MPs are listening in Ottawa. Sorry, Keith.
If you're very hot in the MP space, I think I'm never going to show up in a Canadian podcast ever again.
And that's the main theme that we've talked about quite a bit. Central bankers around the world have been, trying to tighten in a number of different ways. And at the same time, from the fiscal side, our governments continue to spend. And even Powell down the U.S. has been a bit vocal about this over the last 6 months or so. But Michael, I think one of the questions people have for you is, with this bucket, all the holes in it, they're wondering, was this a Greek-made bucket? Because it certainly couldn't have been made in Germany. They would have made a bucket with no holes in it, maybe. That would have solved a lot of problems. But
wait, can I ask one more question? Can I ask one more question, just a little bit off piece? Are you, as a Greek person who suffered because of the German imposed austerity from maybe 8 or 9 years ago, whatever, are you guys enjoying this? Are you having a bit of Schadenfreude watching the Germans tie themselves in knots with their deindustrial policies and their green stuff? Are you kind of enjoying this a little bit?
Personally, I am a lot. I am a lot because I've been patronized and I've been having all these discussions through the crisis by Germans telling me what to do, which, now, in Greece, not many Greeks follow the global economy. They know that Germany has issues, but because they focus on their issues, they don't spend too much time on Germany. The only thing I have to say is that I'm really, really happy that Germany has issues for one reason, not because I don't want Germany to do well, but because for the first time, Greece being counter-cyclical, the ECB will need to cut rates for France and Germany when Greece doesn't need lower rates.
Exactly.
And we will get another tailwind, which will be amazing. So I'm very happy for the counter-cyclicality. And in 2014, the opposite happened. Greece needed to lower the rates, but Germany didn't need lower rates. So we got screwed for that. Now, in this case, we're going to get the tailwind, and I'm very happy for that. I don't want the Germans to, go through an austerity, but I'm afraid because I don't know if you know, there's a constitutional issue in Germany, which the deficit cannot exceed, I think, 3%.
3%.
Yeah, because of what? Because of Hitler
Maastricht
and because
Treaty.
of what?
What's the Maastricht Treaty?
No. They have a constitutional issue.
Oh,
and
sorry.
The constitutional issue comes from the hyperinflation they had, which brought Hitler and everything. So they made it a constitution that they would never have inflation again. So they could never spend the crazy amount. So they've strapped their hands by themselves in this case. So I don't know what will. I don't know. A few years ago, they issued a huge spending program, and the Bundestag came out and said it's unconstitutional and cut it off. So
Yeah,
they
I
have
remember.
these issues, these structural issues, which is positive for Greece. So I'm happy for that. You know what? The euro was a main problem for Greece because it could not lower its currency. So it had to have an internal devaluation. And internal devaluations means cutting your salaries in half. But when you have an internal devaluation and your debt stays the same, your debt to GDP goes 2 times up. So suddenly, going into the crisis, we had a debt to GDP of 125%, which was considered unsustainable. And after 3 years, our debt to GDP was 200% because GDP collapsed. So yes, maybe they can try their own policies and they'll see how well they work. I'm not sure they're going to be very happy with the result. Having practiced it, I can tell you it's not going to be fun.
Thank you.
Go Greece.
Well,
Michael-
everyone, this is something like Michael and I, we have this conversation for like 2 hours, at least 3 days a week sometimes. So it's, but Michael, thank you for your time today. I think everyone really enjoyed the conversation. Hope people are able to relate to what's happening in other markets and that they are very big issues. And, the world has become somewhat synchronized from an economic, social, geopolitical, fiscal policy all the way around. So we do have some potential events happening outside of Canada that could affect us here. Steve, do you want to say the last word for Michael?
Yeah,
before
no,
you,
Michael, just you and I had a conversation previously on YouTube. We said before when you got on the show here, it'd be a 30, 40-minute interview, and we're at an hour now. And I just think it's because it was such a enlightening conversation. It was hard to cut you off because it's just I'm sitting here and just really enjoying the conversation, and hopefully our listeners did as well. We'll definitely have you on for a repeat guest as long as the YouTube algos allow it. And hopefully at some point a Loonie Hour meetup in Greece, my friend.
First of all, thank you very much for having me. It was really fun and really nice talking to you guys. You're more than welcome to visit Greece anytime and have a Loonie Hour in Greece. Probably our next podcast, if we do one together, it will be for your foreign listeners and not for the ones in Canada if I'm banned for what I've said. So hopefully I'm not going to be banned. Thank you all of you guys. It was really nice talking. Thank you, Keith. And I have to say that, again, Keith's work is very helpful to me because it's an independent thought. So I read a lot of Keith's papers. And Keith, maybe I'm smart, but you help me a lot to look smart. Although I think Brent is what drives your smartness. But next time you should have Brent as well on the call, and we can have this discussion in front of everyone, and the truth will come out. But no, thank you thank you guys. It was fun. Thank you. And hopefully we can do that again. And you are all welcome to Greece anytime. Just send me a message And I'll make Keith has promised during the past 4 years that he's going to come, but unfortunately the 49ers do not play in Greece, so his vacation is surrounded of where the 49ers go. So as long as the 49ers don't play in Greece, I don't think I'll see Keith. You guys are most likely to come sooner than Keith to Greece.
Rich will be there next week.
You should.
Michael, thanks so much.
Thank you, guys.
That was a great conversation. I think maybe a little bit outside the box of what we typically discuss on, but I think just good getting those different perspectives from someone outside of Canada looking at the bigger world.
And this is what the big conversations are, though. It's not, which bank stock is doing this, and, like the real stupid Canadian investment conversations usually. There's a lot of very concerned people out there, and this is the kind of stuff that they're thinking about and how it could really affect things going forward. So that was a lot of fun. That was
Keith,
very
I just
fun.
wanted to add something because I just noticed, like, we do our best to try to read comments and feedback, and I think there's some commentary of like, oh, these guys are always so like doom and gloom and the world's gonna blow up, and I think we just want to emphasize that like it's really not the case. We like to highlight the risks that are out there, and then there's obviously there's risk on one side, and as Keith always mentions, on the other side there's opportunity. Right. So there's money to be made in any market, in any event. And I think it's really just identifying these sort of tipping points.
But also, to support that view, Steve, I think it's also people forget markets, and this is something Keith says a lot, are cyclical. And we are at the end or nearing the end of a cycle. And don't take my word for it. Take the Federal Reserve's word for it, and the CPI print that came out today, which we'll probably touch on next week, and the monetary policy that we're seeing around the world. So, if the ISM was very low and starting to rise, our opinions on growth and the direction of travel would be different because, when the data changes, I change my opinion. And what do you do, sir? To quote whichever economist I forgot now. But yeah, Keith, sorry, I interrupted you.
No, it's the same thing. I mean, everyone has their investment style, and it's our view. If you manage your risk correctly, you're going to avoid some nasty drawdowns, which you have to work really hard to try to, get back to where you started. And that's what these conversations about. So you're right, Steve. People might say, hey, you're always talking about this, or that. If you properly manage your exposure to this, and that, then you're going to be a hell of a lot better off longer term. And, as we just heard from Michael, then, is it the Chinese story? Is it the Japanese story? Or who knows what? But there's some pretty big events out there right now that are continuing to stress. Because remember, the number one thing he kept saying, I won't get the number right, but I think he was saying when he said it would take 13 credits to produce one more credit.
Units,
yeah. What he's saying was taking $13 of new debt to create another $1 of GDP. And that's the same thing that we've been talking about here for the Canadian perspective. More and more debt, more and more population growth, just to keep the economy just moving. Yeah, flat. And now everyone else has that same challenge. But the data that really stood out, you hear the debt metrics that the Chinese have today, comparing it to the US story, from 08, 09, and what the Japanese story in the early 90s, and the American one again back in the 80s. It's, debt is pretty cool in that you can't see it, but when it breaks, boy, oh boy, Rich, boy, oh boy.
Boy, oh boy.
No, I mean, yeah, like I said, I think this is, just an important topic that I wanted to emphasize, because I think that we don't want people to be, misunderstanding our viewpoints, which is, at the end of the day, it's like, we are invested, you're maybe not 100% fully invested, but, you're still riding along for the game, and you're just looking for the speed bumps and, looking for places where you have to pull U-turns. And I think that's we want our listeners to take home. I mean, at the end of the day, this is like an economic and finance podcast. If we can help people make a few bucks here and there, that's certainly one of the goals, or at least help people from blowing themselves up. is certainly part of our objective here on the Loonie Hour. So I just really wanted to emphasize that.
And Montreal, we got to emphasize Montreal next week.
Yeah, Rich wants one more free plug here before we sign off. Montreal again, July 18th. There's a ticket link in the bio for Eventbrite page where you can go pick up tickets for the Loonie Hour Social on July 18th. And I think next week there's still lots to cover on in the world. We've got the big elections that happened in France. We'll probably get to that. We had the US CPI data out today, the data we're reporting. We had
UK election.
UK elections. We had Canada's employment figures, which were quite weak last Friday. So there's a lot that we'll get into next week, but we really wanted to bring Michael on because we thought his perspective was much needed at this particular time. And as always, guys, much more to look forward to. We appreciate your support, and we'll see you next week.